All right, so let's begin the show. And as we all know, there are plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? Which fund will help you achieve what kind of financial goals? Now, these are the common questions that investors usually have on their mind. But then let's get all of this answered today. I have with me Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Also, once again, do not forget to send across your portfolio queries on our WhatsApp number, which is 865-797-4571. And you can also email us your questions on the Money Show at etnow.tv. Hi, Gautam, and good evening on the Money Show. It seems you've been appearing after a very long time. Guess you were busy with work and traveling, but then good to have you back once again.
Thank you,
So,
Kalia.
let's begin. We will take Vikas's question via email. I think you have the question on you, Gautam. And he wants you to review his portfolio. Now, the funds that he has in the portfolio are ICICI Pru Equity and Debt Fund. He's got UTI Nifty 50 Index Fund. He's been doing SIP of 6,000 ICICI Equity and Debt and 4,000 in UTI Nifty 50 Index. Parag Parek Flexi Cap, again a 4,000 rupees SIP. Kotak Emerging Equity 3,000. Nippon India Small Cap 3,000. Investment horizon is pretty long term, 25 years. That's what he says. And his aim is to accumulate 2 crores. And he also has a return expectation, which is 12% CAGR. So, let's first talk about return expectation that people usually have from equity. Do you think 12% is decent, or is it too conservative or too aggressive to expect from equity? What do you say?
Kavita, thanks for having me back on the show, and lovely to be here again after a while. Just wanted to answer your question by saying that 12% is a fair assumption, fair ask. Very simply put, if you look at the way India's economy is growing, with a 7 to 8% GDP growth annually, and this is obviously GDP growth in real terms, and you have inflation that is anywhere between 5 to 7%. So if you add both the GDP growth as well as inflation, you get somewhere about 12% plus. And that's really a fair assumption to make, that as long as the economy continues to grow at this pace, corporate India will be primarily responsible for that growth. And that's why shares should also reflect that growth. The share prices should reflect that growth. Obviously, there'll be differences in valuations. There'll be times when the market is very hot and times when the market is quite attractive valuation wise. But on a long term basis, that's a fair assumption to make. I think people shouldn't get misled by last 1 or 2 years performance and start assuming that 15 to 20% is the norm. I think fair 12% long-term return expectation is fair. If you look at the market's performance since inception, then obviously the returns are upwards of 16-17% CAGR. So that's what the market has actually delivered. So I think 12 to 14% is a fair return expectation. Now
All right,
coming to
let's look at his portfolio also. The funds look pretty decent, pretty good. What would you say?
Yes, so very happy to see such portfolios and such questions, because most of the time I end up telling clients to invest more and invest for longer. But very happy to see that Vikas will be able to achieve his target of 2 crores. In the 25 years he's planning, with the assumption of a 12% CAGR. In fact, at a monthly SIP of 20,000 rupees, he should be able to achieve a 3.75 crore portfolio in 25 years. So that is much more than his target objective, assuming that the portfolio delivers 12% per year. As far as his funds are concerned, I think more or less I'm in line, in agreement with all the funds, except for maybe reducing his allocation to ICICI Prudential Equity and Debt Fund. Maybe he doesn't need so much debt, because he's already putting about 6,000, which is the highest allocation there. And if he's comfortable increasing the risk in his portfolio, especially since it's a long-term investment, he can reduce that SIP from 6,000 to 2,000, and the remaining 4,000 he can split. One, he can add an ICICI Prudential blue chip fund where he can put in 2,000, so he'll get a little bit more large cap exposure. and he can add the remaining 2000, he can add to an existing fund, which is the Parag Parik Flexi Cap Fund, so that he can get a little bit more exposure on the Flexi Cap side. Otherwise, I don't think he needs to do any other changes for now.
All right, we don't have him on the phone line, but then let's move on to our next question, which is Amit's question. And now he's interested in a multi-asset category, and he wants to invest a lump sum in this for long term. And he also wants to know which are the best performers in this particular category. Well, Amit, it's a very good idea, and I'm sure, Gautam, you will also agree to this. A very good idea to invest money in a multi-asset, but at the same time, one needs to understand his portfolio allocation and diversification strategy, which is current, and accordingly, maybe he would want to be placed in a multi-asset allocation, because already across asset class, you might want to diversify, but then you also have to be careful about, being over diversified in certain categories. So multi-asset allocation, it is also the flavor, for the investors these days.
Yes. So, 5, 6 years back, when we were shouting from the rooftops and telling clients to invest in multi-asset, it was a very tough sell. But thankfully, what has happened is that gold has delivered fantastic returns. Equity obviously has done quite well. And debt also, it went through a bad patch, but it's kind of started delivering stable returns for debt. So suddenly multi-asset funds in terms of past performance have started to look attractive. So people are taking them seriously. Obviously, from a long-term perspective, it is a good product to have. It is part of your core portfolio because of the auto rebalancing feature. It brings in discipline. It brings in the asset allocation element, which otherwise you have to manage on your own across different assets. So that way it automates your asset allocation and rebalancing. So that's extremely good. As far as putting in a lump sum is concerned, I think especially if it's a long-term horizon, I think it's okay. Please go ahead and put lump sum in multi-asset, Amit. And also a couple of funds that I could suggest, which are research approved funds, is the ICICI Prudential Multi-Asset Fund, the SBI Multi-Asset Fund. Both are recommended from our side. Their 5-year performance are, IPO has delivered about 19%, while SBI has delivered about 14%. These are the two funds that are research approved from our side. So these are the ones that you can consider.
Sure. So that's your recommendation for Amit. We move on to Dhriti's question. And it seems lump sum investment is something that's on investors or our viewers' mind, because Dhriti from Bangalore writes that she also wants to invest lump sum 2 lakhs, and she wants to know if this is the right time to invest. And 1 lakh in equity savings fund, and 1 lakh she's divided as 30,000 in large and mid cap, 40,000 in flexi cap, 15,000 in mid and small cap each. So I really wish she was there on the phone line. We could have spoken to her more about it and gotten all the details, because the way she's looking at it is very interesting. The equity savings fund, how do you like the strategy? 1 lakh you divide across market caps, and 1 lakh you put in equity savings. I don't know her investor profile in terms of her risk appetite, her age, but what does this plan look to you like?
Yes, so I read a lot into the proposed plan from Dhriti because I don't have other information to assess her risk profile. So, basis the plan that she's proposed, I understand that she doesn't want to be an aggressive investor. She wants to be more of a balanced, a moderate risk taker, and that's why my suggestion would be along the lines of what she's proposing, with minor modifications. So the investment amount is 2 lakhs. Typically, someone who says I am okay to invest for 7 years, I would typically go with a more aggressive portfolio unless there are other indicators, and I would suggest more equity exposure. But here I'm going to limit, let's say, the small cap exposure, and I'm going to give a little bit more balanced portfolio suggestion here. So for 2 lakhs, she could invest in a combination of equity and hybrid, which is what she's proposing. So the funds can be this as a suggested portfolio. For equity, ICICI Prudential Blue Chip Fund, where she can invest 30,000. Bandhan Core Equity Fund, another 20. It's a large and mid fund. Mere Asset Mid Cap Fund, another 20,000. HDFC FlexiCap Fund, another 30,000 there. And the remaining 50% allocation, so that equity becomes about 1 lakh. The remaining 50% allocation can be into HDFC Equity Savings Fund, 60,000 rupees, and ICICI Prudential Balanced Advantage Fund, 40,000 rupees. So it's along the lines that she's suggested, built that way, just filled in the scheme names so that she can build her portfolio her way.
Okay. Riti's response to her query. We move on. Let's take Shraddha's question also. So Shraddha writes that she wants to extend her investments in mutual funds to sectoral funds, and she wants to know if having exposure to large, mid cap, small cap, flexi cap category for a long term period, is it good or not, and if at all it has to be a sectoral or a thematic investment or an exposure for 3 to 5 years. What should she pick up?
I would like to give a slightly elaborate response here for Shraddha, because the question actually raises a lot of other questions. So, typically, a sectoral fund is like a tactical allocation or somewhere where you have a deeper insight or a very strong view on, and as an investor, you want to bet on a particular sector. So those are the reasons why investors usually look at sectoral fund. It is not meant to be part of your core portfolio allocation. So when you're investing, you follow a core and satellite approach. So your core portfolio typically is full of large cap, flexi cap, multi cap, maybe some allocation to mid and small, or maybe even a focus strategy. But when it comes to having a sectoral fund, I would not build a portfolio completely out of sectoral funds. So that becomes your satellite portfolio allocation. So in that, I would suggest maybe keep up to 20% allocation in the satellite portfolio sectoral funds. If you have a very, very strong view, then maybe increase it to 25-30%, but not more than that. Better to give the fund manager the flexibility to select and add weightages as the fund management team feels comfortable. Now coming to specific funds for Shraddha, currently we are bullish on three sectors. One is manufacturing, the second is the pharma and the healthcare theme, and the third is the banking and financial services space. So because we are bullish on these three sectors, we've kind of shortlisted sectoral funds from these spaces. So one is the ICICI Prudential Manufacturing Fund, the second is the ICICI Prudential Pharma, Healthcare and Diagnostics Fund, and the third is SBI Banking and Financial Services Fund. So these are the three options that I would suggest that she takes a look at. But this should be only once she already has a core portfolio built.
All right, Gautam, thank you so much. That's all the time I have for our question answer session. So thank you so much, and you guide our viewers every time. Thanks again. With that, it's a wrap on the Money Show as well. But then let's get you our details where you can reach out to us and send across your questions. That is our WhatsApp number and email ID, 865-797-4571. The Money Show at etnow.tv is the email ID. So you can send across your questions and we will get your questions answered live by our experts. Thank you so much for watching. Goodbye.